afternoon and welcome to this ACT webinar on interest rate risk management. I'm Martin O'Donovan. I'm Deputy Policy and Technical Director here at the ACT and will be chairing this session. Before we get going, can I just explain a little bit about the webinar setup? You'll see on the screen various widgets across the bottom. If you need to ask a technical question, there's a box there you can click on, or alternatively, if it's a question for our question and answer session at the end, there's the Q&A box, which I think is in red. We'll be taking questions at the end, but if any questions occur to you during the session, just type them in there as we go. In this webinar, we'll be starting with a case study from Belmond, the Hotel and Cruise Group, formerly known as Orient Express. This will be given by Keith Reed, their Group Treasurer. We then have two speakers from Chatham Financial. Chatham are a leading interest rate and currency risk advisor, so clearly they have the expertise to bring a good degree of rigour to this subject for us. They're sponsors of this webinar, so we thank them for that and for providing our two experts who will be presenting for us, namely George Karanish and Zvi Sacco. So I said, at the end we'll be having questions and answers and a discussion. Could I just add that there will be a recording of this webinar available on the ACT website in about 2 days' time, along with a separate copy of the slides. So, we'll be starting, as I said, with the case study, and then Chatham will be going into the approach that Belmond used a little bit further, and looking at the sort of planning and analysis and execution that's involved in setting up an interest rate management process. So, if we could actually make a start straight away with Keith. I hand over to you.
Thank you, Martin. I'd like to sort of set the scene for the hedging by giving some background to the company and a little bit of background to the transaction itself. Belmond, as Martin said, formerly Orient Express, is a collection of 45, we like to say, iconic hotels, cruises, railway journeys, which are in around 18 countries. And unlike a lot of our competitors, we actually own the hotels, which are really focused on the luxury leisure markets. Belmond is a bit of an odd beast. Though its head office is in London, it's a New York Stock Exchange listed entity, and it reports under US GAAP. And just to give you some sort of financial metrics, group turnover is around $600 million a year, EBITDA around 120, and we have debt of around $640 million. Capitalization is about 1.4 billion. About 40% of our assets are euro denominated assets, predominantly in Italy, and then the rest is mainly dollars, but we are represented in a lot of strange locations such as Peru, Myanmar, Vietnam, etc. Our relationship with Chatham probably goes back 4 or 5 years, and I think an important factor to consider is that the Belmond Treasury Department consists of 2 people. So up until March this year, the group was financed by asset-level debt. So each of our properties was effectively mortgaged, normally to a collection of local banks. And the lenders were really focused on the performance of those individual hotel assets rather than the group. And as a consequence, we had property-level financial covenants and sometimes group-level financial covenants. And often each individual loan would stipulate the amount of interest rate hedging that was undertaken. Now, the obvious disadvantage of this structure was just complexity. We had issues moving cash from one security package up to the parent, and we were faced with constant refinancing. Now, as the group's debt came down over the last 5 years due to better trading, disposals, some equity issuance, the opportunity to replace all the asset level debt with a corporate facility presented itself. So in March of this year, having reorganized the group structure, obtained credit ratings, and also changed the brand, we raised $552 million through the Term Loan B market and put in place a $105 million revolving credit facility. So all the proceeds from this new debt were used to replace existing asset level debt, and we cancelled around 33 interest rate swaps which were secured as part of the asset level finance. The term loan itself pays a floating rate of interest and has a 7-year maturity, and the revolving credit facility has a 5-year maturity. And the term loan has a dollar and a euro tranche, and approximately 50% of both tranches were swapped from floating to fixed interest rates. So considering the hedging itself, this whole process took around 6 months to complete. And throughout this time, as well as negotiating term sheets and loan documentation, we were considering the type of hedge and how best to execute it. And I think although there is a temptation to invest huge amounts of time solely in the debt instrument itself, the hedge is arguably just as important, and the two sets of documents need to be considered together. In a lot of ways, we were quite fortunate because the counterparties of the hedge were going to be the revolving credit suppliers. So we knew the banks that we had to talk to, and throughout the 6-month process, we entered into a dialogue. All of the counterparties knew that Chatham were involved in this transaction, and we, I think, had a very open and sensible discussions with our banks because of Chatham's involvement. So I would just like to touch on some of our key considerations before we executed the hedges, and then George and V will sort of develop these themes. So in this particular financing, there was no requirement to actually enter into any hedges at all. But the board were historically very comfortable with having a portion of fixed rate debt in their capital structure. And in the past, this was due to protect financial covenants. But in this case, that was less of an issue, and it was more about getting some certainty around the interest rate charge going forward. We always aim to achieve hedge accounting for any interest rate derivatives. And a slight complexity in this particular transaction was that the debt had a 1% floor. Equally important to us was the currency denomination of the term loan. With 40% of the group's EBITDA and assets being generated in euros, we obviously wanted to raise euro debt to provide a natural hedge against those assets and cash flow. However, the Term Loan B market is a predominantly dollar market, and at the start of the transaction, we had no idea whether we could raise natural euros and the potential additional cost we would pay on those natural euros, and whether there was actually a benefit in raising dollar debt and then swapping it synthetically into euros using a currency swap. So with Chatham's help, we spent a lot of time looking at the economic benefit of raising straight dollars, and we also had to try and assess the capital cost of counterparties entering to a cross-currency swap with us. And we'll develop these themes sort of later on. But actually, as we moved forward through the transaction and we had more confidence about the demand for a euro tranche, we finally decided that actually the pricing differential between the natural and synthetic euros was not sufficient to warrant the additional complexity the cross-currency swap would result in. We also had to consider the maturity of the swap. As I mentioned, the term loan has a 7-year maturity and the RCF has a 5-year life. Because the RCF really represents the refinancing event, we decided that the swaps we entered into would have a 5-year life. And at the time of the transaction, we also, and still are considering, whether there is any benefit in entering into any out-of-the-money caps to provide some protection on the floating rate should rates really rise. So a second work stream that was going on at the same time was really the whole regulatory and documentation issues, which tend to be left to the end of the transaction, but in fact we had to register the hedging entity for Dodd-Frank and EMIR, and there were obviously bank KYCs issues, bank accounts to be opened and ISDAs to be agreed. And throughout this process we were talking to our auditors and to Chatham to ensure that the derivatives were going to qualify for hedge accounting. When it comes to the actual execution itself, we were really focused on having a transparent and efficient execution. And George will talk about this in more detail. But we used one bank to buy the market hedges at an agreed spread, and these were then passed on to the other counterparties, and we'd agreed the capital charges that the other counterparties were going to levy ahead of the actual execution, and swap amounts were allocated on the basis of the capital charge. I think the only slightly disappointing part of the transaction was that we had these 33 existing interest rate swaps, and at the start of the transaction we thought we would be able to get those novated to the bank that conducted the market hedge. But in fact it proved a complete documentation nightmare to try and get these swaps novated. So in fact we had to cancel them with the existing counterparties. So hopefully that gives you some sort of flavour to the transaction, and I'd like to pass over to George, who will take you through the stages.
Thank you very much, Keith. Good afternoon, everyone. I will firstly start with a couple of generic slides which apply to most businesses that are looking to introduce a risk management policy. Slide number 6 is providing some guidance on what building blocks corporations should consider during the designing process, that slide, of a robust interest rate risk policy. The foundation of a best-in-class policy is what is the objective and the purpose of having a well-defined framework. Is it to minimize interest cost, Is it to reduce interest volatility, or is it, for example, to add value to the business by allowing certain exposures to interest rates? This can vary depending on the business and the financial profile of the organization. How to achieve this objective? The risk management process in relation to what and how to hedge, internal compliance process, the monitoring and reporting of the performance, as well as accounting constraints shall be clearly defined. All these different steps are summarized in that slide. Moving into more specific considerations, slide number 7 is providing more details around the what to hedge and how to hedge building blocks. In our view, best practice in building a robust interest rate risk management framework would be to consider different factors such as the business profile of the organization, the debt structure, credit constraints, future financing, peer group interest rate risk management policies, as well as the interest rate environment before a debt issuer is determining the optimal debt currency mix as well as the optimal fixed floating mix of their interest rate portfolios. For instance, interest rates and volatility. While floating rate debt has traditionally been cheaper, it is also more volatile. We have seen that some corporations only use that factor to determine optimal fixed floating level decisions, and therefore they tend to increase their portion of fixed rate debt when interest rates are at historically lows and reduce that portion when interest rates are at historically high levels. Business profile is another factor. Cyclical businesses that are tied to economic cycles and their operating performance is closely related to short-term or long-term interest rates could lean towards a more floating rate debt approach. On the other hand, businesses with stable revenue streams could choose a more predictable interest expense line and therefore have more fixed rate debt. Other factors such as capital structure, financial metric restrictions, future funding plans, and peer group benchmarking can be considered towards that decision-making process. To summarize on the strategic assessment of risks, we have so far considered the building blocks of an effective policy, as well as the factors that can influence decisions in relation to debt currency mix, as well as debt profile mix. We will now move into addressing some of these factors in more detail, presenting some examples. Slide number 8 is referring to an issuer that has euro and dollar assets and is considering raising debt. Slide number 12, I apologize, is referring to an issuer that has euro and dollar assets and is considering raising debt in both currencies, either directly or synthetically through a cross-currency swap. This specific example is analyzing a 5-year euro and a 5-year dollar loan with an embedded floor of 1%, which was a similar case to Belmond's debt structure. As we will see, regarding euro liabilities, it will be more cost efficient to raise dollar debt and swap into euros by 30 basis points rather than issuing debt in the euro market. However, credit charges, capacity constraints, and accounting considerations need to be taken into account before the corporation is actually making that decision. During the analysis of comparing the pricing efficiency between raising in dollars and swapping back into euros or in euros directly, there are different factors that need to be taken into account. First of all is the credit spreads on the euro and dollar loans. Secondly is the currency basis, which is the price for swapping a 3-month dollar loan into a 3-month euro loan. For that specific maturity, the currency basis at the moment is 5 basis points benefit issuing in dollars and swapping back into euros. 3 months ago, it used to be close to 10 basis points. Last year was as high as 30 basis points. So that benefit can be volatile. Finally, the value of embedded floors or embedded options on the debt structure under both currencies needs to be quantified. In that instance, the value of 1% floor in euros is 45 basis points, and the value of the 1% floor in dollars was only 20 basis points. So there is an inherent benefit of 25 basis points from issuing debt in dollars and swapping into euros. However, as I said, all in all, there is a 30 basis points benefit, but before the decision-making process is made, there are other considerations that also need to be taken into account. Moving into next slide, slide number 13. Following the assessment of the most efficient issuance opportunity from a currency perspective, the next 2 slides will address the question how much and how to hedge. On that slide, the dark line in the middle is presenting the forward curve of dollar LIBOR over the next 7 years. The light blue area is presenting the probability of LIBOR moving upwards by 1 standard deviation, and the dark blue area by 2 standard deviations. Equally, the yellow areas are presenting the probability of LIBORs moving downwards by 1 or 2 standard deviations. The red line is presenting the 5-year dollar swap rate today. The black line, the 5-year swap rate as expected by the forward curve in 12 months' time, and the dotted lines, the plus or minus 2 standard deviation movement on 5-year swaps. The key takeaway from that slide is that despite the fact that interest rates are at a very low level currently, it is also important to look at the probability of future interest rate movements. LIBOR could be as high as 4% in 2 years' time, and 5-year swaps could move up to 4% in 12 months' time under a certain probability. This methodology that we are presenting in that slide is taking into account probability of future movements using implied volatility assumptions, and we believe that is superior to actually running sensitivity analysis applying parallel shifts to the interest rate curve. And as we said, because we are in a very low interest rate environment with medium to high volatility, there is substantial potential for interest rates to move upwards and less potential for rates to move lower. This asymmetry between upside and downside potential can have a high impact on the risk profile of the organization. Moving to next slide, slide number 14 is using the underlying dollar LIBOR scenarios that we presented in the previous slide and overlaying different hedging strategies is presenting the development of interest rate expense over a 5-year horizon. This slide is highlighting the parameters around not only the decision on how much to hedge, but also how to hedge. This analysis will help the companies to assess the impact of different interest rate scenarios on the income statement, credit ratios, as well as other metrics. We are considering in that slide strategies with swaps, which result in higher certainty and predictability of interest expense, as well as strategies with caps, which provide protection in a very high interest rate scenario, as Keith mentioned previously. We are also considering a combination strategy which includes swaps and caps. However, the same logic and type of analysis could be used and include other hedging products such as floors, swaptions, or other instruments. As you can see in that slide, being 100% unhedged can result in a very high interest expense, especially after year 3 or 4, when interest rates are expected to rise significantly. If you compare that unhedged strategy with buying an out-of-the-money cap, while there is a small upfront cost associated with that strategy, the worst-case scenario is much less. In the interest of time, we will not go further into the details of the other strategies, but we will conclude that section and move into the execution strategy phase. We believe that the objectives during the implementation phase of an interest rate risk management process should be transparency, execution efficiency, cost efficiency, as well as diversification of counterparty risk. These objectives can be met by applying either competitive auction as an implementation strategy or even a direct negotiation. The optimal strategy depends on the number of transactions, transaction size, transaction type and maturity, timing and market liquidity, and documentation constraints. In other cases, as it was the case with Belmond, someone can choose a hybrid strategy, and this can be more efficient. Executing the market hedges with one market dealer and then auction the credit and capital charges to other counterparties. This can help the hedging process. It can improve transparency and efficiency as long as there is agreement on pricing methodology and hedging costs. This strategy can also achieve very competitive credit charges by introducing competition amongst the market dealers. Finally, diversification of counterparty risk is another element that can be achieved using that strategy. Moving into the next slide, we will be providing more details around documentation and structuring complexities, which we believe are very important topics, which will then lead to better pricing. Starting from the execution process, by negotiating an effective structure and robust documentation, as we said, will help during the pricing process. As a general message, debt and derivative structuring, ISDA negotiations, debt documentation negotiations should happen in parallel in order to ensure efficiency, better and consistent terms, as well as flexibility. The bank counterparties tend to negotiate for documentation clauses that are in their favor from a counterparty risk point of view, with the aim to have less credit and funding charges and therefore higher profit margin and of course higher credit line availability. Corporates need to have a clear understanding of the value of certain clauses and the implication to their businesses under certain scenarios. They will then be in a better position to negotiate a more robust debt and derivatives package at a more efficient price. And to conclude my section, the final slide number 18, is providing a breakdown of the components of an all-in price for a derivatives transaction. All-in price is important, but having transparency around the cost of each component can result in a more cost-efficient hedging process, both when entering into a new transaction as well as when terminating early an existing transaction. This is a very useful reference and negotiation point to have visibility around certain charges, the bank's profit margin, as well as the bank's view of capital and credit risk. This slide concludes the policy, strategic assessment and implementation phase. To summarize, it is important for debt issuers to introduce a holistic and disciplined approach to interest rate risk management. Due to the bank's regulation, there is a wide discrepancy regarding all-in derivative charges as well as documentation requirements. It is therefore important to have the expertise and the experience to ensure transparency and efficiency in relation to both derivatives pricing and documentation negotiations. With that, I will hand over to Zvi to touch upon the accounting considerations.
Thank you, George, and good afternoon, everyone. As George mentioned, accounting is at the top of the structure on slide number 10, and companies should consider the accounting implications early on in the deal process. Ideally, companies would want to seek the hedging structure that best aligns the economics of the hedging program with the accounting results. The first slide, slide number 20 on the left-hand side, shows that the default accounting treatment for derivatives is that they are shown at fair value through profit and loss, creating volatility. This is not only relevant to companies that apply international financial reporting standards, or IFRSs, but is also becoming relevant for all companies that apply UK accounting standards, or UK GAAP. Effective 1st of January 2015, UK GAAP is changing and being replaced by the requirements of FRS 102. Without going into too much detail, this standard brings many of the accounting rules of IFRS into UK GAAP and requires that derivatives are now accounted for on the balance sheet rather than being only in footnotes to the financial statements. This could mean more earnings volatility, potential tax impacts, banking covenants needing to be retested, and companies' abilities to pay dividends needing to be assessed. However, this is not all bad news for you. Provided various criteria are met, both under IFRS and FRS 102, companies can elect to apply hedge accounting rather than the default accounting treatment for derivatives. As already mentioned, under the default accounting treatment, even economically effective hedges that eliminate or significantly reduce specific risks could result in P&L volatility. However, as illustrated on slide number 20, hedge accounting aims to alleviate this mismatch by modifying the normal basis for recognizing gains or losses on derivatives and the underlying hedged transactions such that they are reported in P&L in the same period. Hedge accounting therefore aligns the economics of a transaction with the accounting, thereby reducing or eliminating P&L volatility. Moving on to slide number 22, we're going to look at slide number 22 before slide number 21. This slide looks at the various steps needed to implement hedge accounting, and I'm going to touch on some of these steps briefly. Firstly, formal hedge documentation needs to be in place, which sets out details of the risk being hedged, the hedging instrument or derivative being used to hedge the risk, and how effective the hedge will be in offsetting the hedged risk. A system needs to be in place not only to value the derivatives, but also incorporate a credit valuation adjustment, known as a CVA, into the derivative's fair value. This is a relatively new requirement that came into effect on the 1st of January 2013. Calculating CVAs for derivatives can be complex, given that the future credit exposures of derivative contracts can change from being assets to liabilities and vice versa. Consequently, both your company's exposure to the bank and the bank's exposure to your company needs to be assessed, which can be challenging for many companies. The next step is to calibrate and separately value a hypothetical derivative, which is the perfectly effective derivative that has the terms that are identical to the critical terms of the hedged transaction. This will be used to assess the effectiveness of the derivative in offsetting the hedged risk. Hedge effectiveness can typically be assessed using statistical regression analysis, which is our preferred approach, or the dollar offset method. Finally, accounting journal entries would need to be processed as well as disclosures in the financial statements, which can prove challenging and time-consuming. As we have seen, hedge accounting is complicated, but it does not need to be hard. companies need to have the right system and expertise to help them navigate through the process. In our view, the use of spreadsheets or simple technology solutions to apply hedge accounting is becoming more and more challenging and costly to maintain, given the operational risk of errors, the complexities of the new standards, and increasing audit time spent on auditing manual workarounds. Your company may need to consider using a technology system that is able to run valuations, CVAs, effectiveness tests, journal entries, and disclosures in an integrated and consistent manner. Moving on to slide number 21, I wanted to touch on some of the high-level accounting issues we dealt with during the Belmond restructuring. Companies need to be aware of these issues and other accounting implications at the beginning of a deal to ensure that an economically effective hedge doesn't break the hedge accounting and cause P&L volatility. The presence of the 1% floor in the loan that Keith mentioned creates complications, as this can be viewed as a written floor that could possibly be required to be separated as an embedded derivative and measured separately at fair value, resulting in P&L volatility. Should a company have to separately account for an embedded derivative in its loan, it may need to rethink how it structures the hedges. For example, it may consider trading a vanilla swap and a purchased floor as two separate instruments rather than embedding the floor premium in the swap rate. This may result in better hedge accounting treatment depending on whether the company is following IFRS, UK GAAP, or US GAAP. Another consideration relates to the accounting for cross-currency swaps. Cross-currency swaps have a significant mark-to-market fluctuations, and the ability to designate them for hedge accounting becomes important to avoid P&L volatility. This is a complex area, but companies should be aware that they could consider separating a cross-currency swap into its different component parts and designating them separately to achieve favorable hedge accounting. Moving on to slide number 23. I just wanted to recap and emphasize that failure to consider accounting implications early on in the deal process may significantly limit accounting options post-deal. Companies would need to assess whether they have the internal expertise to be able to navigate through all the accounting guidance and whether they have adequate systems that can handle hedge accounting and all its complexities. I'll hand over to Joel.
Yep. Thank you very much to all our speakers. We will now move on to the opportunity for your questions. Please type them into the Q&A box. I should say we'll be dealing with all questions anonymously. Can I actually just do one of my own, actually? Because one of those earlier graphs showed the sensitivities of the different outcomes of different hedging strategies, looking at the future probability distribution of interest rates. Perhaps can I ask Keith, how was that received in terms of your own management? Because it seems to paint a very good picture, a very vivid picture, but was it quite alarming to your directors to see the possible outcomes expressed like that?
I think, firstly, I didn't show it to the board. I just shared it with the finance director because we don't want to frighten everybody. I think that obviously you are looking at two standard deviations, and that's a very extreme event. What it did provoke was thoughts that whether we should actually go ahead and put in place, as I mentioned, some out-of-the-money caps, just to give us some protection against these extreme events. Up until now, we haven't done that because actually we felt the price of these caps was so high that actually we weren't convinced it was the right thing to do. I think we will continue to monitor and revisit it. I think the one thing I would say is that because of sort of where the company is and the debt instrument we issued, financial covenants are not such a concern to us today as they were in the past. So we do have that flexibility that perhaps we didn't have previously.
Great, thanks for that. I mean, again, still staying on those graphs of probability distributions of where interest rates could, or the range of outcomes, but can I just turn to George from Chatham and say, where would a company get that sort of information from? Can you generate it yourself, or is it available on screens like Bloomberg and so on?
Thank you, Martin. It is a complex calculation behind this type of analysis. We can certainly provide this sensitivity analysis using that methodology. Corporations could also, using some data feeds from Bloomberg plus some Excel modeling, could replicate this type of analysis as well. But as I said, it requires some technical knowledge to do that.
Imagine, yeah. Okay, taking one of our questions that we've had come in, Vandermeer questions really directed towards Belmond and the strategy of terminating various swaps. But the first one here is can you just explain the 1% floor? I mean, the rate paid will never drop below 1%? Yeah.
Correct.
So, I mean, is that the market norm, or was that something that you specifically inserted into the agreement?
No, it is a function of that particular market. With dollar rates, LIBOR rates where they are, investors want to have that floor.
So that has become quite normal.
Yeah.
Right. The other question relates really to the terminating of the existing swaps. And I don't know whether this is for you or SSB. Did terminating the 33 existing swaps affect or damage future hedge accounting? Does it somehow taint the fact that they were hedges? The fact that you closed them and haven't run their course?
Yes, so the hedge accounting, because there's new instruments being issued, we had to consider breaking the hedge accounting for the old instruments and then designating the new interest rate swaps for hedge accounting. That was the policy we had to follow.
Right. And again, still on some of these rather technical elements of swaps, I've had the question here, won't the need for the CVA adjustments be effectively removed? This is when we're talking about the valuation of swaps. Won't it effectively be removed when the market moves towards central clearing? So I think that's related to if you either go through clearing or put up collateral, will the corporate still need to do a CVA adjustment to their valuations of their derivatives?
Yes, it's a good question. I think definitely the CVA requirement will become less burdensome or onerous, and yeah, possibly depending on how often they settle and all the type of collateral that's posted, etc. But certainly the CVA requirement will become less onerous.
George?
To that point, I would only like to add that most corporates that we see obviously are NFC minors, so they are not obliged to use collateral. Some of them, they are considering bilateral CSA agreements, which requires a cost-benefit analysis in order to decide if it makes sense to put CSAs in place. On the one hand, you need to consider the benefit of reduction on derivative charges, and on the other hand, the liquidity risk. But at this stage, it is not relevant for the majority of corporates that we see in the market.
No, I think, again, from the ACT's experience, the provision of collateral is quite rare for corporates, although it is one of those things that I do wonder whether the market might be heading there, or indeed, as George has just said, whether there is actually a cost benefit in from going down that route. Okay. Again, turning to the actual execution of the swaps, can you say a little bit more about running a competitive auction for the swap execution? How does that process work then?
Thank you, Martin. That depends on the number of transactions. If there is one transaction, then you can put documentation in place with more than one counterparties and ask the counterparties to submit an all-in price for this particular transaction at a certain point in time, and then you choose the best price. This methodology can be more complicated if there are more than one number of transactions, or if it is a higher size that needs to be split into different type of transactions. Then alternative strategies may be considered, or a hybrid strategy may be considered, which is to do a direct negotiation on the market hedge and then auction on credit and capital charges and syndication of that swap to more than one counterparty.
Okay, thank you for that. Just changing the subject a little bit here, there's a question: what are the key controls that an internal auditor should test within interest rate hedging? What are the key controls around that an internal auditor might be interested in? I guess it's really to do with the approvals process, I suppose.
Yes, I think that's right. You want to ensure that the transaction has been approved by the relevant board committees. I would say you would want to ensure that the ISDA document is in place and signed. You would want to ensure that confirmations are being sent. You would want to ensure that the entity is registered for EMIR or Dodd-Frank reporting. I think those sorts of issues should be addressed.
And I guess the only other thing is compliance with policy. So if there is an interest rate risk policy, that this policy is adhered to on that specific transaction.
So further question on the actual execution and I guess the rates achieved on these swaps. To what extent did Basel III impact on banks? The impact of Basel III on banks impacted your decisions in terms of cost, appetite of banks, and so on. Were there great variations? Some banks are incorporating Basel III to a different extent and therefore are more or less competitive.
I mean, our experience and actually we just worried about what the capital charges were. We didn't ask for the justification. I'll be honest, they were very, very competitive, and perhaps any institution that was a slight outlier was prepared to adjust their pricing. So, to my view, it didn't have a huge impact on us.
Right, so I suppose it comes through in what they're prepared to offer you in the end. Another one here. How far forward should you be hedging interest rates? And if you're too far forward, does that affect the hedge accounting? I think that's two questions there.
Yeah,
how far forward is reasonable to...
I guess it is important, Martin, to quantify refinancing risk over the following years, looking at your business plan, and therefore take the decision to perform pre-hedging accordingly. And then from a hedge accounting point of view...
George, I was just going to add hedge accounting. You want to make sure that you've got an underlying hedge and exposure that you're hedging, and you don't want to hedge out too far because you run the risk of not getting the appropriate hedge accounting, given that there's not necessarily highly probable future forecast transaction that could happen.
Great, thank you for that. Well, I guess our time is ticking by. 50 minutes is really not a long time to do justice to this subject, but I hope this provided food for thought. Certainly, when looking at interest rate management, there is a lot of various permutations to think about. I mean, George, I think that you have another occasion coming up when you're talking about this.
Thank you, Martin. Yes, very briefly, Chatham is, and me personally, are presenting a webinar around managing the interest rate risk, currency risk, and inflation risk around debt programs on the 25th of June. More details can be found on the Thought Leadership section of the Chatham Financial website, and the audience is more than welcome and invited to join our webinar. Thank you very much.
Well, anyhow, thanks very much to all our presenters and to Chatham Financial for your sponsorship, and thank you too for everyone who's joined this session. As I mentioned at the start, there will be a recording of the webinar up on the ACT website in the next couple of days. Then, looking forward, there will be further events being organised by the ACT. We have 2 further webinars already in the calendar, and indeed various conferences you can see there, including the ACT Europe conference in Dusseldorf. So, thank you very much for listening. If you can spare a few moments to give us some feedback on the webinar, we'd be very grateful. If you click the little red icon at the bottom, there's an opportunity there to provide that feedback. So, from all of us here, thank you and goodbye.
Thank you very much.